Welcome to another deep dive. Today we're plunging into a pretty complex and, well, rapidly evolving situation. The Turkish economy as we see it in May 2025.
Indeed. There's a lot going on.
Yeah, and our source for this dive is this really comprehensive report. The title's a bit of a mouthful in Turkish, but essentially it's an up-to-date, deep analysis report for May 2025.
And what's interesting, I think, is how it pulls together existing research, but layers in the very latest data, plus perspectives from various experts.
Exactly. So our mission here is to, cut through all that complexity. We're going to unpack this report, pull out the key insights, and give you a clear, well-informed picture of what's happening now. We'll look at the challenges, the opportunities, and maybe what the next 6 to 12 months could hold.
Think of it as your fast track to getting up to speed on this specific, quite intricate topic.
Right. We've done the reading so you don't have to. Okay, let's dive in and unpack this report.
Well, the report definitely paints a picture that's complex, no question. You've got this mix of persistent inflation, quite a bit of currency volatility, and growth that seems, well, fundamentally unbalanced in some ways.
Okay, so let's start with those big numbers, the macroeconomic picture the report lays out. How's it looking right now?
Well, the report points to a clear slowdown in growth. It was, relatively strong at 4.5% back in 2023, but that slowed to 3.2% in 2024. Now, looking ahead to 2025, the international forecasts cited in the report, they vary a bit, but generally land somewhere between, say, 2.6% and 3.1%.
So different bodies seeing it slightly differently.
Yeah. You've got the IMF predicting 2.7%, the World Bank's a little higher at 3.1%, the EBRD at 2.8%, and the OECD coming in at 2.6%. And the report really links this slowdown mostly to the tight monetary policy that's been in place and also just the general economic uncertainty kind of hitting demand.
Makes sense.
It is worth noting, though, the World Bank did mention the possibility of maybe 4% growth in 2026, but that's a big if. It's really conditional on getting structural reforms accelerated.
Okay, now, inflation. This is where, frankly, things look a bit concerning, especially with the latest data points, right? What's the report saying there?
This is where the report flags something critical and very recent. The 2K data, that's the Turkish Statistical Agency, it showed annual inflation hitting 58% in May 2025.
Wow, 58%. That's quite a jump.
It's a huge jump, especially when you think just 2 months before. In March 2025, it was recorded at 38.1%.
So that earlier drop, maybe from the 75% peak, that wasn't the start of a smooth trend down then.
Exactly. That drop down to 38% felt, maybe hopeful, like the disinflation process was starting. But this 58% figure in May, according to the report, it really changed the picture. It raises serious new concerns and strongly suggests that getting inflation down is proving much, much harder than maybe people hoped.
So what does that mean for the forecast for the rest of the year?
Well, when the report mentions those international forecasts, like the IMF's 35.9%, though that's an average for the year.
Right.
Or the World Bank and OECD both looking at around 29% by year end. The report itself points out, quite explicitly, how optimistic those numbers now look compared to the current reality of 58%.
Huh.
Given that May data, the report's own analysis leans towards something like 45% to 50% end-year inflation being a significantly more likely scenario.
So that injects a lot more uncertainty around hitting targets.
A huge amount, yeah. It really throws a wrench into the expected timeline for disinflation.
So it is happening, but just much slower and bumpier than hoped.
That seems to be the takeaway, that May data was a real signal about how sticky this inflation is proving to be.
Okay, what about the jobs picture? Unemployment.
Right, so for 2023, the general rate was 8.5%. Youth unemployment was higher, 16.3%. However, the report also mentions other analyses that put youth unemployment quite a bit higher, maybe over 25%.
Why the discrepancy?
Well, the report suggests this gap and the challenge overall is linked to how the economy has been growing recently. It's been concentrated more in capital-intensive sectors.
Meaning using machines, not necessarily lots of people.
Exactly. Requires big investments in tech and machinery, rather than being labor-intensive, which would create more jobs, especially for younger people entering the workforce.
Yeah.
So you get growth, but maybe not the kind of job growth you need.
That's a critical distinction. Growth is one thing, job-rich growth is another. Okay, let's talk interest rates and the Lira. The policy rate's 50%, but you just said inflation's 58%. The report sees an issue there, doesn't it?
It absolutely does. This is a really core point of concern in the report. A 50% policy rate when inflation is running at 58%? Well, that means you have negative real interest rates.
Meaning the interest you earn doesn't even cover the price rises.
Precisely. As one economist quoted, Aladdin Ali, points out, This gap between interest rate and inflation really hurts the credibility of the policy. And think about what negative real rates do. For you as a saver, it means the real value of your Lira savings is actually going down. So it discourages saving in Lira.
And pushes people
Towards things like foreign currency. People want something that holds its value better. That increases demand for dollars or euros, which then puts more pressure on the Turkish lira, accelerating its depreciation. And that currency volatility, in turn, creates big headaches. It hurts companies with foreign debt. It knocks consumer confidence. Another economist cited, Bayram Basharan, stresses that consistency in rate policy and FX policy is just critical to try and break that cycle and build some confidence back.
So the core message from the report is the policy rate at 50% just isn't high enough relative to that 58% inflation to do the job of encouraging saving or stabilizing the currency.
That's the key insight, yes. It's seen as insufficient to generate positive real returns or properly anchor people's expectations about future inflation, given where inflation is right now.
Okay, last piece of this macro puzzle from the report, the current account balance. What's the story there?
The report gives a range for the deficit. That's basically the gap between money coming in and money going out of around 1.4 to 1.5% of GDP. But it also flags that the IMF is forecasting a significantly higher deficit for 2025 at 3.8% of GDP.
That sounds like a big difference. Why does that matter?
It matters a lot because a 3.8% deficit means Turkey needs to attract substantially more money from abroad foreign investment, loans to cover that bigger gap.
And is that easy right now?
Well, that's the challenge. And a major driver pushing that deficit wider, noted in the report, is the cost of energy imports. They account for a hefty 7.2% of GDP. So with global oil prices hanging around, say, 90, 95 numbers a barrel, buying that energy puts direct, significant pressure on widening that current account deficit, more money flowing out.
Right, that makes perfect sense. High oil prices hit importing countries hard.
Exactly.
Yeah.
Okay, so we've got that macro picture laid out. Now let's shift a bit and talk about the policy responses, what's actually being done. And according to the report, how effective is it proving? What are the impacts?
Yeah, let's start with monetary policy. How's it grappling with that 58% inflation, given the rate is 50%?
Well, as we just discussed, the report really hammers this point. The 50% rate versus 58% inflation means negative real rates continue. And this, the report argues, raises serious questions about both the effectiveness and the credibility of the current monetary stance. The suggestion is, if inflation doesn't start falling more decisively, the central bank is going to face mounting pressure. Either hike rates further or keep policy tight for much longer than may be planned.
And both of those options have downsides, right?
Absolutely. The challenge is, either hiking more or staying tight for longer would almost certainly slow down economic growth even further. It's a tough balancing act. The report keeps coming back to this, showing consistency, linking interest rate moves clearly to efforts to stabilize the currency. That's vital for rebuilding investor confidence, both here and internationally.
Okay, and what about the government's role? Fiscal policy spending, taxes, how does that fit in?
The OECD view, which the report cites, is that tight fiscal policy, basically, the government watching its spending carefully, is needed to help cool down demand in the economy. That supports the fight against inflation.
But is that happening?
Well, that's where it gets complicated. Other bodies, like the IMF and World Bank, are cited as having some concerns about fiscal discipline. You've got pressures, like the high cost of energy imports we talked about, that strain the budget. And potentially, there are needs for more social spending, given the economic pressures people are facing. So the report stresses that maintaining fiscal discipline while also pushing ahead with needed structural reforms, those are critical not just for now, but for medium-term stability too.
So another balancing act. Need to be tight to fight inflation, but facing real pressures to spend on energy and maybe social support.
Precisely. It's a difficult needle to thread.
Okay, that covers the big picture and the policy levers. Let's get more specific now. What does the report tell us about how different sectors of the economy are doing?
All right, let's dive into some specifics. Starting with industry and manufacturing. The report notes pretty decent production growth, 4.2% in the first quarter of 2025. But here's an interesting and maybe concerning detail it highlights. The automotive sub-industry. It's a big part of manufacturing, but it's apparently 72% dependent on imported intermediate goods.
Wow, 72%. So they need to buy most of their parts from abroad.
Seems like it. And that means the production costs get pushed up significantly, especially when the currency is volatile or depreciating.
Which ties right back into the currency challenges we discussed earlier.
Directly, yeah. Hits their input costs, affects competitiveness. Now, on the flip side, The report does point to some positives in manufacturing. The defense industry and the electric vehicle sector are mentioned as areas showing real technological progress. And that's supporting value-added exports, meaning Turkey's selling more sophisticated, higher-value stuff abroad. Machinery exports, too, that's another bright spot, expected to top $25 billion in 2025.
Okay, so some strengths. Any potential weaknesses flagged there?
One potential risk for the longer term that the report mentions is R&D spending, research and development. It's still only about 1.2% of GDP. To really keep moving up that value chain and stay competitive globally, you ideally need more investment in innovation.
Got it. Strengths in some areas, but challenges with import costs and maybe needing more R&D focus long term. What about services and tourism?
Services sector also showed pretty solid growth, up 6.1% in Q1 2025. Health tourism is specifically mentioned in the report as having high potential for investors, though it does add a note that it's probably best suited for investors who have a higher risk appetite.
Okay. Construction always seems busy. What's the report's take on that sector?
It is active visually, yes, but the report highlights a really significant underlying issue: the cost of financing. Apparently, financing costs make up something like 40% of the final sales price of housing.
40%, just the financing.
That's what the report states, yeah. Huge. And you combine that with the current high nominal interest rates, even if they're negative in real terms, and it makes the investment costs really tough, maybe unsustainable for developers. So the report's point is, this structure prevents the creation of genuinely affordable housing, even if more units are being built. The financing model itself is a major barrier.
Interesting structural problem. Okay, agriculture. You mentioned food inflation earlier. The report touches on drought.
It does. It highlights that drought conditions led to a 15% drop in wheat yields. And that, as you said, feeds directly into food inflation, which is a big part of that overall high inflation number. The report also notes that there hasn't been enough investment in modern irrigation systems. That makes the sector more vulnerable to weather shocks like drought and hinders planning. And one other point, only about 2.8% of agricultural land is certified organic. Suggests maybe Turkey's missing out on opportunities in niche, potentially higher value markets there.
Right. Okay, final sector block. Finance and technology, especially fintech, looks like a growth area.
Digitalization definitely seems strong there. Digital banking usage is reported as very high, 89%. And fintech investments looked robust, $1.2 billion just in the first half of 2025.
But there's always a but.
Well, yeah. The report flags risks, too, even in this fast-growing area. Things like regulatory uncertainty, the rules maybe haven't quite kept pace with the innovation, and cybersecurity challenges are mentioned as significant hurdles. E-commerce also grew strongly, up 35%. But again, a practical issue flagged is logistics infrastructure, maybe delivery networks, warehousing apparently. Issues there are hurting profit margins for e-commerce companies. So yeah, lots of potential, but real practical and regulatory challenges to navigate too.
Okay, so we've looked at the big numbers, the policies, the sectors. Now the report tries to bring this all together, identifying the main factors that could really steer the economy's path from here. Basically, the key risks and opportunities over the next, say, 6 to 12 months.
Right. Let's start with the downsides. What are the major risks the report is highlighting? Well, number one, unsurprisingly, is that high and sticky inflation, especially after seeing that 58% print in May. The report sees this making the whole disinflation job much harder, and it raises the risk that people's expectations of future inflation just get stuck at a high level, which kind of becomes a self-fulfilling prophecy.
Makes sense. What else?
Closely linked is the issue of monetary policy credibility. The report argues it's undermined by those negative real interest rates, that gap between the 50% policy rate and 58% inflation. Then there's currency volatility, still seen as a big risk, hurting companies, hurting investments.
Any external factors?
Yes, definitely. High global energy prices, oil around $90 to $95, that keeps pressure on the current account deficit and adds to inflation. The report also mentions the broader global picture: tight financial conditions worldwide, general uncertainty. Institutions like the EBRD highlight these as risks, making it potentially harder or more expensive for Turkey to get external funding.
And domestic risks beyond inflation.
Yeah. Delaying necessary structural reforms is flagged as a risk that holds back more sustainable long-term growth. The report also interestingly notes a risk that strong domestic demand could actually add more fuel to the inflation fire. And finally, policy predictability comes up. Moody's, the rating agency, is cited mentioning weaknesses in policy predictability. That increases the risk premium investors demand, which is reflected in Turkey's B2 credit rating.
Wow, okay, that's a fairly sobering list of risks. Is there anything on the opportunity side of the ledger, according to the report?
Yes, despite those significant challenges, the report does identify several potential opportunities. Some are fundamental long-term strengths. Turkey's strategic location, its young and dynamic population, those offer growth potential down the road. Then there's the growth we saw in some value-added sectors like defense, EVs, machinery exports.
Hmm.
That's seen as a promising area to build on.
Anything else stand out?
Renewable energy is highlighted. Turkey apparently has a good wind capacity factor, around 42%, making wind power look attractive. Energy efficiency technologies are also mentioned as an opportunity area. And related to what we discussed earlier, the high rates of digitalization, the growing fintech sector, e-commerce that provides a strong base for more expansion in the digital economy.
What about for investors looking at, say, the stock market?
The report does touch on potential value investment opportunities. It notes the BS 30 index, the 30 biggest companies on the Istanbul Exchange, was trading at a price-to-earnings ratio of about 7.5. That's below historical averages. So the report suggests this might offer some selective buying opportunities, particularly maybe in export-focused companies in sectors like automotive or chemicals.
But there's a catch, I assume.
A very important one, yes. The report has a strong warning. Investors absolutely need to consider how dependent these companies are on imported parts or materials that ties back to the currency risk. And also the risk of global demand slowing down, which would hit exporters.
Okay, so opportunities exist, but they come with significant strings attached. You need to be really selective and very aware of the broader risks.
Exactly. It's not a straightforward buy signal, more like potential value here, but proceed with extreme caution and do your homework. So, building on those risks and opportunities, the report then lays out a few possible scenarios, kind of potential paths the economy might take over the next 6 to 12 months, helps frame the range of outcomes.
Okay, what's the report see as the most likely path, the base scenario?
The report describes the base scenario as one of, well, slow and difficult disinflation. So in this path, the current tight policy stays in place, but inflation only comes down gradually from that high 58% level. It probably ends the year still pretty high, maybe in the 40–50% range, significantly above those earlier, more optimistic forecasts. Economic growth stays pretty subdued, maybe around 2.5 to 3.0%. You'd probably see the currency continue to depreciate, but in a controlled, gradual way. And policy credibility, it would build, but only slowly, needing consistent, sustained actions over time.
Okay, slow grind. What would a more optimistic scenario look like, according to the report?
The optimistic scenario hinges on a quicker policy response that really manages to build trust faster. This would likely mean stronger policy action, maybe more front-loaded, perhaps a significant rate hike beyond the current 50%, or other tightening measures. Crucially, this would need to be paired with very clear communication from the central bank to really anchor people's expectations and boost market confidence quickly.
And the result?
In this scenario, inflation would fall faster, maybe even get below 35% by year-end. You'd likely see greater currency stability, too. Now, the report notes this path might mean a sharper economic slowdown in the very short term as that tighter policy bites harder. But the upside is it would potentially lay a much stronger foundation for stability and more sustainable growth in the medium term. Short-term pain for long-term gain, essentially.
And the flip side, what's the pessimistic scenario?
The pessimistic scenario is where things go wrong. You get persistent inflation, maybe it even ticks up a bit, but policymakers hesitate to tighten enough. Perhaps they're worried about slowing growth too much or other political factors come into play, or maybe they loosen policy too soon. And then, on top of that domestic policy challenge, imagine an external shock hits, like a big new spike in global energy prices or a sudden freeze up in global financial markets, making it much harder to get foreign capital.
What happens then?
The result in that scenario is pretty grim. High inflation stays stubbornly high, maybe even worsens. Pressure on the currency ramps up significantly. And overall macroeconomic instability deepens. Things could get quite difficult. Okay, so keeping those scenarios in mind, the slow grind, the faster fix, or things getting worse, the report then tries to translate all this analysis into some strategic thinking for investors, or really anyone trying to navigate this environment.
Right, what does this all mean for you, the listener? What are the key strategic takeaways from the report's analysis?
Well, the number one message, loud and clear, is prioritize risk management and portfolio diversification. That's critical. The report notes that with yields on things like KKM, those currency-protected deposits, now falling below inflation, people are actively looking for alternatives. It mentions things like FX-denominated government bonds or maybe gold-backed instruments being explored.
But holding lots of foreign currency has risks too, right?
It does. The report specifically warns that holding a really large chunk of your portfolio, mentions over 30% in foreign currency, can actually increase your balance sheet risks if the lira were to suddenly strengthen or stabilize more than expected.
Yeah.
So it strongly recommends including assets that offer some protection against inflation. Things like real assets, maybe property. Though remember those construction sector financing issues we talked about, or specific inflation index financial products.
And liquidity, being able to access your money.
Very important. The report suggests keeping a significant portion of your assets. Some analyses cited apparently suggest around 40% in liquid form. Cash, or things easily converted to cash, that minimizes liquidity risks and gives you flexibility to react if conditions change quickly.
Okay, risk management, diversification, inflation protection, liquidity. What about focusing on specific parts of the economy or different types of investments?
The report suggests considering defensive sectors, things like food retail, healthcare, telecommunications. These tend to hold up better during economic slowdowns. For areas with potential mid to long-term growth, it points back to energy efficiency and renewables, especially wind, digital infrastructure. And for those willing to take on more risk, maybe areas like health tourism or educational technology startups. And those value-added export sectors, defense, EVs, machinery, are also flagged as potential growth drivers over time.
And what about those value opportunities on the stock market you mentioned?
Right, the report revisits that bias 30 low PE ratio, suggests it might offer selective chances, especially in export-focused auto and chemical companies. And this is a crucial, but it hammers home the warning.
Yeah.
You absolutely have to factor in their dependence on imports and the risks from slowing global demand. It's not a simple call.
So the overall strategy.
The report recommends an integrated approach. Combine some sectoral differentiation, carefully distribute risk across different asset types, be open to alternative finance models if they make sense for you, and crucially, given all the uncertainty, you have to closely monitor policy actions, watch the macroeconomic data as it comes out, and be ready to adjust your portfolio. Keep it flexible, keep it dynamic. In an environment like this with negative real interest rates, a primary goal for many people, maybe the main goal, is simply preserving the real value of their savings and investments. Don't let inflation eat it all away. So to kind of wrap up the report's main assessment, as of May 2025, it's clear the Turkish economy is facing some really significant hurdles. Primarily that high and persistent inflation, the ongoing challenge of achieving sustainable currency stability, and finding a path back to growth that actually creates enough jobs. The report's analysis really emphasizes that the effectiveness, and maybe just as importantly, the credibility of economic policies over the next 6 to 12 months, that's going to be the key factor, determining which of those scenarios plays out. It strongly concludes that showing real determination in tackling inflation, speeding up those structural reforms, and increasing the overall predictability of policy. Those are essential steps needed to regain trust, both from Turkish households and businesses and from international investors.
Yeah, it's really clear from this report that the path ahead is, well, uncertain and definitely challenging. It really underscores that for anyone watching this situation, whether you're an investor or just trying to understand what's going on, caution, really solid risk management, and diversification are absolutely key right now. The next year or so is going to be incredibly important, isn't it? Everyone will be watching closely to see how these policy choices interact with those external factors and which direction the economy ultimately starts heading in. And maybe here's a final thought for you to chew on as you think about this deep dive. The report lays out these different scenarios for Turkey's economy, right? And they're heavily influenced partly by policy choices made inside the country, but also by these big, sometimes unpredictable forces from outside, like global energy prices or shifts in international finance. It just makes you wonder, for any economy, how much of its future path is really steered by the deliberate actions taken domestically by the people in charge, and how much is just determined by these huge, sometimes uncontrollable currents flowing in from the rest of the world. It's a fascinating question to keep in mind as we watch how things unfold, not just in Turkey, but everywhere. Thanks for joining us for this deep dive.